Okay, students, Appendix B is actually one of the most valuable, but also one of the most potentially confusing parts of Business 2. It's a very, very valuable skill for you to learn in all business aspects, whether you're in accounting, financial analysis, personal finance, whatever it is. It's very, very valuable. So I'd encourage you to read Appendix B more than once, play these lectures more than once, and really try to grasp this concept, because once it makes sense, it's very, very valuable to you. Okay, here's how it works. We're going to start off with an example. And guess what? You've won the lottery. But you got two choices. You can take all the money up front, or you can have $500,000 every year for 20 years. Okay, so the lotteries are worth $8 million now, or $500,000 every year for 20 years. Which option would you take, and why? Think about it for a minute. Some people might say, well, you know what? 500,000 times 20 years, that's 20 times $500,000. That's actually $10 million if you just do the simple math. If you take the $8 million now, though, you get it now. Most people will figure out that getting the money now has some value over taking $10 million over the course of 20 years. In fact, the last $500,000 you take in year 20 would be so far in the future that $500,000 wouldn't buy nearly as much as $500,000 buys now 20 years ahead of time. So those are things to consider. So that's an introduction to this concept, the time value of money. We know that the value of getting cash in the future is less than getting it now. Number one, you can't invest it. Number two, it buys less. If you take $1 or $1,000 and shove it under your mattress instead of putting it in the bank, might not make much interest in the bank, but it will certainly make no interest under your mattress, and prices will go up. It's very rare that prices go down. It does happen, but it's rare. So your dollars actually decrease in value if they're not invested and matching inflation right now. Whoever holds the cash can earn interest on it or invest it. That's one of the reasons for having the cash early. And so the time value of money depends on this assumption set. Number one, you got to look at how much interest can it earn risk-free. This is a very, very key concept, especially for those of you who want to go on to graduate school or get a four-year degree. You've got to understand that where there's high returns, there's often higher risk. So risk-free is generally perceived as 3-month treasury bills. A very, very low rate right now in America. Rates are really low, okay? So it's not going to make a whole lot of money, risk-free. What other investments could it be used for? You have to consider opportunity cost. If you were going to forego the $8 million right now, then you got to figure out what else could I use that money for, okay? Or if you're going to invest it in one option, say option number one, then you got to take a look at what are the other options you would be giving up if you went with option one. Obviously, everybody has different expectations. Okay, if you are a company, say a General Electric, or a Facebook, or Google, or an Intel, or an HP, you've typically got to figure out how much you expect your investments to earn for you. Not all of them are going to make money. In fact, many of them are going to lose money. Most new businesses fail, and most business ventures do fail. So you've got to understand that many of these are going to come back with no return on investment. Therefore, the ones that win, hopefully you've got to win a decent amount. At Intel, when I worked there, the internal rate of return required was 15%. You had to assume over the life of the project, over the life of the product line, or the new venture, whatever it was, you had to make 15%. That's pretty good. If you can make 15% of the stock market, you'd be doing great right now. Okay, a couple definitions as we move forward here. Present value is the value today of a future stream of cash flows. This is very critical. Okay, if you were buying a business right now and the business said, hey, we're going to make you 10 grand a year, every year, forever, you've got to say, what's the value of that today? Because you can only make decisions today. What this means is that you have to bring all those future cash flows back to today through a process we call discounting. And how you discount those actually depends on the interest rates and how far out in the future they are. The future value is just the opposite. If you were to say, I want all my money to be worth a certain amount at a future date, then you would take a stream of cash flows and you would push them all out into the future and say, by the time I'm 65, I need to have $1 million in the bank. Or by the time my daughter is 18, I need to have $200,000 set aside for a college fund. Or by the time I'm 30, I need to have this much money set aside for a down payment on a house. So you can push payments into the future. But again, the same assumptions. You need to know the timelines. You need to know the interest rates you're going to assume. And these are assumptions because nobody knows exactly what interest rates are going to do. Okay, speaking of interest, simple interest would be only on the principal for each period, and that's not so common. Compounded interest is the interest on both principal and any accrued interest. So the power of compounding basically comes from you make interest upon the interest upon the interest if you go 3 years out. If you go 20 years out, well, obviously interest upon interest upon interest upon interest, 20 times, it really magnifies. And so the power of compounding is critical. When you look at interest, you got to understand it's the principal times the interest rate times time, and we're going to use fractions of a year here, or we'll use a 360-day year as we did for loans. But in this whole chapter, in this appendix, we're only going to be dealing in half years or years most of the time. Okay, a couple things in these problems, both in the book, online, and here in these lectures, all interest rates given are annual unless stated otherwise. Okay. Interest rate has many different terms. Okay, we might call it a discount rate. It might be called the coupon rate when we get into talking about bonds, which is chapter 10. And you'll hear these phrases quite a bit: rate of return, internal rate of return, or return on investment. All three of these are used interchangeably depending on the company terminology. Okay, another one might be required rate of return, RRR. But typically, what this means is this is the interest or the return on investment that something is going to make for you. Okay, so we use those terms as we go forward throughout this chapter. Okay, I think I'll get into this example in the next segment of the lecture, so skip ahead to that next lecture.